Hey, it's me, Brad Hammond here, your local Portland area real estate loving agent. I want to talk to you about cash flow and why that is important or not important, and why that doesn't quite work as a metric in the Portland area market. So, things I want to talk about is I get it why cash flow is important and why a lot of people look at it. I want to talk about market appreciation, tax advantages, debt paydown, and value add. Um, I talk fast. I know that about myself. I've got a lot of information to cover here, so I'm going to talk fast. I want to try to blow through it to save you some time as well. A little bit about me, why you should maybe trust me is I've been investing in real estate since 2008. I've done long term buy and hold, I've done short term rentals, I've done live in flips, I've done a little bit of everything within the real estate investing community. I've dabbled in a lot of it. I know a lot about different ways to make money in real estate. I am a real estate agent and I am here to provide value to you. I only ask that you use me to help present you to buy and sell. All right, so the allure of cash flow. I get it. This is a spreadsheet that I've created. It is a analyzer tool on analyzing short-term rentals or long-term rentals on cash flow. Here, let me get my face out of the way here. So when I'm looking at this one, if you look at the bottom line here, it is losing $236 per month. That's not a huge amount of money, but money's still money. When I dive into a little bit further, I see that the maintenance and CapEx is $152 per month. So call that $300 a month right there. If we were to manage this a little bit differently, know this going in and say that, hey, I've got Brad Hammond as my real estate agent. I know that he isn't going to negotiate well for me, and we're not going to have any maintenance and repairs. Oops, sorry about that. Any maintenance and repairs for the first year or so. Then now we can help pocket a little bit more of that money. Same thing with CapEx. If the appliances are in good shape, hot water heater, and the HVAC systems are all in good shape, then maybe we don't need to pocket that $152 and save it for later, like we would if there is an intimate need for some of those items or a new roof. Also, we have the vacancy here at $160 per month, so we can incentivize the tenant in order to stay a little bit longer if they're a good tenant, and use other modes to get them to stay that are not monetary so that we don't have those vacancies that are reoccurring. So if we look at all three of those, now we're looking at about $450 a month cash flow positive. No, sorry. I additional cash flow, excuse me, versus losing $236 per month. So it doesn't necessarily matter what's on the analyzer tool. It matters how you are going to manage the property. I'm very happy to help you out with that, but don't just take a look and see what's on black and white. Really dive in and see what the actual property is giving you. If it's got the location, the amenities that you are looking for, that is more important than what it says on month one of the analyzer versus year 10. So market appreciation is huge. I love me some of market appreciation. The historical appreciation in Portland is right around 4.75%. And yes, there is fluctuation there, of course. You've got in 2021, it was around 12% per year. Can you imagine that? Like 1% per month appreciation versus lately, it's been closer to that 1.5% or flat appreciation. But historically, let's look at 4.75% appreciation. However, you are only putting down maybe 25% down. So if we were to multiply that out, now your appreciation on that 25% is closer to 19, 20% appreciation on that down payment. That is huge. That's more than you're going to get in the stock market, more than you're going to get in a lot of different businesses. So that alone is going to be a big indicator as to why you should focus on appreciating markets. Also, you got rent increases of 3% to 5.5%. That's going to matter more on multifamily when you've got cap rates and things like that involved as well. All right, so tax advantages. I was blown away. Blown away. The first 2 years, I had investment properties at the amount that I was able to get back in taxes from my investments. So, of course, you are doing your depreciation. Basically, the government is saying that you can depreciate a certain amount of the asset. You can take off from your taxes the amount that you're paying towards your mortgage interest every month. And I think that that is really powerful because in the first 2 years, you're paying more in your interest than you are in your debt pay down. So that is going to help prop you up the first few years. And then later you can pocket that money for debt pay down into equity. Talk about that later. Expense write-offs. So look, of course, you're going to be deducting the mortgage insurance like I just talked about, your repairs, the insurance. You can deduct the local and state taxes. But what about the cell phone bill, your internet, your home office, your mileage, all these little things? That is how you want to capitalize on these expense write-offs so that you can add up all these nickel and dimes to really kind of create a good tax write-off for yourself the first few years. Capital gains taxes. Yes, you can 1031. I've opted to pay taxes in the past. There's really pros and cons to doing it both ways. However, I think that it's going to be advantageous for you to not pay, let's call it $100,000 in capital gains tax right now versus doing a 1031, kicking it down the road and paying that $100,000 in, let's just call it 10 years, 15, 20 years. I would much rather pay it than when you've got inflation working for you and those types of things. Last thing is you are going to have a lower tax rate because it's going to be a long-term gain versus a short-term gain like you would have with a standard flip. Basically meaning that if you hold it for a year or more, the percentage of tax you're going to be paying is quite a bit less. All right, let's talk about debt pay down. So your tenant is paying the debt pay down for you. That is huge. I just need to repeat that. The tenant is paying this for you. So all of that money, the $7,000 or $10,000 in real numbers that you are putting down in equity, your tenant is doing that for you. As I alluded to earlier, year one, your mortgage payment is mostly going to be the tax deductible interest, but there's going to be a little bit that gets put into the debt pay down, and then that's going to gradually grow over the years. But yes, if you can do that $7,000 to $10,000 per year, that is nothing to sneeze at. And then the wise investor, the smart investor, is going to leverage that debt pay down into another investment down the road. Okay, value add. I'm not talking about doing a studs out remodel when I'm talking about value add. I am talking about doing something like, well, I guess it really kind of depends on what it is that you're looking to do and when you're looking to sell. If you want to sell this in 10 years, then yeah, let's just wait. If you're looking to sell it a little bit sooner, then yes, maybe we can rehab the basement and polish the concrete floor, put up some drywall, some insulation, put in a half bath and some drywall partitioners in there and some framing. Then that's going to add some value, some living space in there. Maybe we can switch out the kitchen appliances, redo the flooring, some paint. Those types of items are going to give you a lot of ROI on your investment. But let's not do that until you're ready to do a refi or you're ready to sell. Happy to consult with you on those items. But when you value add, now you're double dipping because you are creating value and you're taking advantage of all the other items that I just talked about. All right. In conclusion, look, I think that if you are going to focus on cash flow, you are tripping over pennies to save dollars. Wait, did I do that right? Is that right? Basically, you're focusing on the wrong thing. In the Portland market, you want to be focusing on appreciation because that is where you're going to be making your wealth. If you can buy in a good location, a solid property with solid rent growth, with solid appreciation, you are going to be making lots and lots and lots of money and equity in that versus buying something in a cash flow market or buying something that's out in the tertiary markets where it's going to maybe be a little bit more management heavy, where you're going to be maybe getting a little bit less for rents and getting a little bit more cash flow. But if you can focus on the inner parts of the good markets, whether that's Portland or Beaverton or Vancouver, that is where you're going to be making the vast amount of your wealth, and really kind of focusing on that is going to be the way to go. What are your thoughts here? I know I might have made some enemies on this one because a lot of the investors I talk to say, hey, I really need that comfortable cash flow every month. I'm fine if it's cash flow neutral, but I really don't want it to be cash flow negative. I understand it, but I think you need to flip your mindset a little bit and think that I'm not just throwing away that money that I'm putting towards the business and putting towards a property. I'm putting it into a savings account. I'm putting it towards a 401k, if you want to look at it that way, instead of just like throwing it out there into the ether, giving it to my tenants. A property in Portland is going to appreciate more in the long run than other markets and is really going to give you the wealth that you need down the road. I really want to hear what you think about this. I probably maybe created some other questions in your mind about this. Happy to talk about it. I got to get going, but let's talk about this soon. All right. Talk to me soon.